Welcome back to the session. We're going to explore capital structure theory under the traditional approach. Hope you watched the previous three approaches. This is the last approach. The traditional approach to capital structure suggests that there exists an optimum debt to equity ratio. That is optimum debt equity mix. What is optimal debt equity mix? The debt equity mix which increases the market value of firm and decreases the cost of capital. Clear? When you say optimum debt to equity ratio or optimum capital structure, okay, or optimum debt to equity proportion, what does it mean? Which means where the overall cost of capital is minimum, okay, and the market value of the firm should be maximum. So this optimum capital mix or optimum debt to equity ratio is a point in the chart. On either side of the point, changes in the financing mix can bring positive changes to the value of the firm. Before this point, the marginal cost of debt is less than marginal cost of equity. That is, before optimum debt equity mix, cost of equity is more, cost of debt is less. Clear? So it is mentioned as before the debt equity mix point, before optimum debt equity ratio, the marginal cost of debt is less than cost of equity. And after this point is vice versa. Okay, before the point, the cost of debt is less than cost of equity. After the point, cost of this debt is more than cost of equity. Clear? See, there are 3 points. The middle point, let us have point 1, 2, 3. From the bottom, you count point 1. That is before the point where cost of debt is less than cost of equity. Then in the middle point, there is point number 2, where there is an optimum capital structure, optimum capital mix, which has lower overall cost of capital and a higher market value. Correct? As per the theory which we have discussed just before. Third point, which is above the optimum capital structure, where cost of debt is more than the cost of equity. Here, the traditional approach to capital structure advocates that there is a right combination of equity and debt in the capital structure at which the market value of the firm is maximum. That is true. When you say debt and equity mix is optimum, a right combination of debt and equity in the capital structure, it means where there is a point, the market value will be the maximum and the minimum overall cost of capital. As per this approach, debt should exist in the capital structure only up to specific point. This I am insisting from the capital structure theory beginning itself. Every organization should have a minimum level of debt or debt up to a specific point, beyond which any increase in leverage. What is leverage? We have seen in the previous video. What is leverage? Leverage is using of borrowed debt at a fixed charge to acquire the fixed asset. Correct? Beyond which an increase in leverage would result in a reduction of value of firm. After certain point of debt, you are increasing your debt size. That is, you are exercising your leverage more. That would result in reduction of market value of the firm. It means that there exists an optimum value of debt to equity ratio at which weighted average cost of capital, that is overall cost of capital, is the lowest and market value of the firm is highest. Once the firm crosses the optimum value of debt to equity ratio, The cost of equity rises to give determinal effect to weighted average cost of capital. Above the threshold, the weighted average cost of capital increases and the market value of the firm starts a downward movement. It means decreases. So overall, this theory talks about there is an optimum debt to capital ratio for every company. That optimum debt equity mix is not a fixed one, correct? That is not a fixed one, but optimum debt equity ratio exists, correct? When it exists at that point, if you look at the overall cost of capital or weighted average cost of capital is the minimum and the market value of the firm maximum, or overall cost of capital or weighted average cost of capital decreases and the market value of the firm increases. Clear? Let us look at the assumptions under traditional approach. The rate of interest on debt remains constant for certain period. Thereafter, with an increase in leverage, it increases. It means when you get more debt, when you raise finance through debt to capital, increase in debt leads to increase in interest. Otherwise, the rate of interest on debt remains constant for a certain period. The expected rate by equity shareholders remained constant or increased gradually. So both the assumptions are applicable here. The return expected by the equity shareholders sometimes remain constant, sometimes increases gradually. Whenever the expectation of equity shareholders increase gradually, you should assume that the firm has increased its leverage. That means the firm borrowed more debt so that the expectations of equity shareholders have considerably increases, because when you employ more debt capital, there is a more risk in the business. When there is a loss, all these debt holders will not come to share it because they are not owners, but equity shareholders have to bear it. Correct? So when there is a high risk, they expect high return. After that, the equity shareholders start perceiving a financial risk, and then from optimal point and expected rate increased speedily. Okay. When they feel the financial risk, when the financial risk will occupy the company, when the debt to capital goes beyond the point, financial risk increases, bankruptcy risk increases. If the firm crosses certain point, okay, then market value faces the downtrend. Market value decreases. When market value decreases, equity shareholders demand more dividend because they lose the credibility they had with the company. Because the market value is going down, you are getting more debt into the company. So equity shareholders, they want to get more dividend and they want to sell off the shares. Clear? As a result of the activity of rate of interest and expected rate of return, the weighted average cost of capital first decreases, then increases. The lowest point on the curve is called optimum capital structure. Next, a snapshot. Traditional approach advocates that there is a right combination of equity and debt in the capital structure, at which the market value of the firm should be maximum and overall cost of capital or weighted average cost of capital of the firm should be minimum. Hope you remember the meaning of overall cost of capital because I explained in the first video. As per this approach, debt should exist in capital structure only up to specific point, beyond which any increase in debt or any increase in leverage sorry would result in reduction of value of the firm. That's what I said. There are 3 points. Point number one, that is cost of capital is less than cost of equity. So point number two, optimum capital mix. So beyond point number two, there is something called point number three. That is what they're talking here. Beyond specific point, that is point number three. Increase in leverage, it means increase the, cost of debt is more than cost of equity. In this case, the debenture holders and the bankers will get more interest than the company owner's share, that is dividend. The shareholders will not get anything, or they will get the lower return. But these guys will take majority of the amount because they invested much in the company. That's what it is mentioned. Beyond specific point, any increase in leverage or debt would result in the reduction in the value of the firm. Assumption: the rate of interest on debt remains constant for a certain period. The expected rate by equity shareholders remains constant or increases gradually. The weighted average cost of capital first decreases, then increases. Thank you for attending the session. Have a wonderful day.